As you know, the webinar was supposed to be broadcast at 11 o'clock on Thursday. And we decided to postpone it because of the events that had taken place in Washington over the last few days. It is truly an American tragedy, and it will affect the country for a period of time to come. We decided not to revise the 10 surprises and the also-rans in spite of it, but we thought it was appropriate to make a comment. Surprise 1 and 13 approached Donald Trump with a touch of whimsy. What might have been appropriate whimsy on January 4th when we recorded this webinar doesn't seem quite so appropriate today, but we're going to leave it in as is for you to make your own judgment on it. Joe, do you have some comments you'd like to make?
Thank you, Byron. I'd just like to echo your comments about this being a tragic period in American history, and our sympathies go out to all those who have suffered through this horrific ordeal. Thank you. Welcome to our annual 10 Surprises webinar. I'm Joe Zidle, Chief Investment Strategist, and I'm joined by Byron Wien, Vice Chair of Private Wealth Solutions, and my partner in investment strategy. Welcome, Byron.
Great to be here with you, Joe. One more year.
Perfect. Well, we're excited to bring you the 10 surprises for 2021. This is a process that begins in the summer with a series of benchmark lunches to ascertain where consensus is on a broad array of subjects, covering everything from investing to politics. We then spend the fall meeting regularly to sift through the many ideas, reading hundreds of reports and testing all those against our views. We meet with many subject matter experts along the way. We finalized the list over Christmas break and we still tweak them right up to the last minute. Our goal in the 10 surprises isn't for a score, as Byron will explain. Our goal is to stretch our thinking and in turn, hopefully stretch yours. So today we'll introduce the 36th annual 10 surprises. And in the time that remains, we'll go through some of the key charts that influenced our thinking. So with that, I'm going to turn things over to you, Byron. Take it away.
I think it's important to start out by saying, what is a surprise? Our definition of a surprise is an event that we believe is probable, having a better than 50% chance of happening, where the average professional investor would give it no better than 1 out of 3 chances of taking place. If you're looking at the list, the ones that are most controversial right now are number 2, that we are able to develop a more harmonious relationship with China. Number 4, where the Justice Department softens its case against Google and Facebook. And then let's go to the 6 through 10 list. I think number 10, the slide in the dollar turns around. Those 3 are the most controversial of the 10 surprises on the list this year. The broadcast today will take about 40 minutes of your time. We're not going to have any questions this time around. We will in the webinars that we're going to do for the next 3 quarters. But we know everybody's busy coming back to work at the beginning of the year, and so we wanted to be as efficient as possible. And so whereas the webinar usually lasts an hour at the beginning of the year, we've tried to cut it a little bit so you can all get back to work. We're not going to take the time up to review the surprises of 2020. There'll be an essay out next week that will analyze each of the surprises of 2020. But let me say overall, it wasn't such a bad year. The ones we got right, we usually got right for the wrong reasons, and the ones we got wrong, we can blame on COVID-19. But you can see for yourself when you read the essay. Let's get right into the surprises of 2021. The first one starts with a little whimsy. President Trump starts his own television network. He also plans his 2024 campaign. His lead program on the network is The Chief, in which he weekly interviews heads of state and CEOs with management styles like his own. His virtual interview with Vladimir Putin draws more viewers than any single television program in history. Look, we're trying to predict the future here, and nobody can really do that. We have enough humility to know that we can't do it. So we thought we'd start the 10 surprises of 2021 with admitting to that and putting a little whimsy into the list. So we'll see what Donald Trump does after he leaves office. We believe it is an imperative that the United States improve its trade and diplomatic relationship with China. As you can see from the left-hand chart, we export about $130 billion worth of goods to China, and we import over $500 billion worth of goods from China. We represent a significant portion of their trade, and they a significant portion of ours. The US share of China trade is about 12%, and they're 14% of our trade. So the United States is important to them as a trading partner, and they're certainly important to us. It is very hard to find anyone else in the world that can produce the quality of goods that China is able to do at the price they're able to do it at. So I think we must improve our relationship with China, and that has to be the number one priority of the State Department.
Surprise number 3, the success of between 5 and 10 vaccines, together with improvements in therapeutics, allows the US to return to some form of normal by Memorial Day 2021. People are generally required to show proof of vaccination before boarding airplanes and attending theaters and movies and sporting events and other large gatherings. The Summer Olympics, which was postponed last year, are going to be held in July with spectators allowed to physically attend. What this chart highlights is the cumulative 2021 year-end vaccines available or number of treatments. And our view here is that by the second quarter of 2021, virtually any adult in the United States will be able to raise their hand in order to receive a vaccine. And by the third quarter, returning to something that looks a lot more like normal.
On this one, we're dealing with the big tech companies. We say the Justice Department softens its case against Google and Facebook, persuaded by the argument that the consumer actually benefits from the services of these companies. The government is taking the position that they are anti-competitive, that these companies gobble up startups that could compete with them. And the consumer is worried that the companies sell their personal information. So certain divestitures are proposed, surveillance restrictions are applied, but the broad effort to break them up loses support. And the bar charts below show there's somewhat less enthusiasm for breaking up the big tech companies than there has been in the past.
The next surprise, the economy develops momentum on its own because of pent-up demand, and depressed hospitality and airline stocks become strong performers. Fiscal and monetary policy remain historically accommodative. Nominal economic growth for the full year exceeds 6%, and the unemployment rate falls to 5%. We begin the longest economic cycle in history, surpassing the cycle that went from 2010 to 2020. And as we think about the airline and hospitality stocks becoming strong performers, the charts I'd want to highlight here show what is likely to be the driver. It's a low base. In other words, as we look at the year-over-year comparisons, the base effect is going to show extremely high growth rates. If you look at the TSA checkpoint numbers, if we go from 500,000 back up to 1 million or 1.5 million, you're going to be looking at massive year-over-year gains because of that base effect. And as we look at the stocks in the subsector on the right-hand side, hotel, cruises, and airlines, we think that they're going to end up recovering back to their prior levels, which is going to show the strongest growth rates. Turning to the next surprise.
Okay, here we have the deficits. Modern monetary theory is here to stay, whether we like it or not. You can see that the budget deficit has increased very substantially to more than 3 trillion, and with the new $900 billion program, it's going to be even greater than that. And we're financing it with the Fed buying treasuries. So federal debt levels are increasing, but interest rates are declining. That's not the way it's supposed to happen, but it's the way it is happening. So it relieves the Treasury of the burden of worrying about interest rates rising, inflation rising, and so forth. We've seen no increase in inflation, no increase in interest rates, and that's given the government and the government the license to expand federal expenditures, and the Treasury the ability to issue bonds to finance government activities. How much longer that'll go on, I don't know. Everybody wonders what'll stop it. The warning sign will be a rise in inflation, but so far we haven't seen that yet. On this one, you can see yet another sector. We've been probing those sectors that haven't participated in the market. Oil is clearly one of them. It's hard to believe, but as recently as 2010, the energy sector was in the teens as a percentage of the S&P 500, and now it's down to low single digits. And as a result of that, the rig count has declined and the price of oil has declined. We think that when the economy opens up and people have the vaccine, they'll be driving more, they'll be going to group meetings, theaters will open, sports events will take place. And as a result of that, the consumption of energy will increase. So we think that that's a sector that, while it's rallied from the bottom, is still an opportunity for investors.
Surprise number 8, while the equity market will broaden out in our view, stocks beyond healthcare and tech will participate in the rise in prices. Risk on, however, is not without risk, and we think the market will correct almost 20% sometime in the first half. But we think the S&P 500 will end up trading at 4,500 later in the year. Cyclicals beat defensives, small caps beat large, and generally the K-shaped recovery will begin to unwind. I think big cap tech will be the source of liquidity, and those stocks will be the laggards for the year. Essentially, in the unwinding of the K trade, those companies that led the market in 2020 were the ones that could provide growth in an environment with tremendous amount of uncertainty and excess liquidity. A few companies could weather the storm. They were rewarded with higher valuations in 2020. But as conditions improve, we think that this trade unwinds, and those lower quality, smaller companies and cyclicals and deep cyclicals could end up outperforming. I think 2021 will be the year of the rotation. Looking at the next surprise, we think the surge in economic growth causes the 10-year Treasury yield to rise to 2%. The yield curve steepens, but the concomitant increase in inflation keeps real rates near zero. The Fed wants the strength in housing and autos to continue, and as a result, it extends the duration of bond purchases in order to prevent higher rates at the long end of the curve from choking off credit to consumers and businesses. I think this will be a real source of conflict in 2021 between investors who are expecting higher interest rates and inflation, and a Fed who's going to want interest rates to remain very accommodative. As a result, I think they'll end up shifting their holdings to the long end of the curve. And as you can see in the chart on the left-hand side, the holdings, their holdings of 10-year treasuries, 10-year and beyond treasuries, I think will increase. I think what's interesting is if you revisit Operation Twist back in 2012, that was a time when the Fed shifted its buying to the long end of the curve. And you can see that represented on the chart on the right-hand side, where the share of the Fed's holdings in 5-year duration and greater was moving higher. And at the time, it brought Treasury yields down to what were then record lows. I think we see a version of Operation Twist 2.0 in this surprise. And surprise number 10, the slide in the dollar turns around. This is one that is very much out of consensus. It was a source of a lot of debate between Byron and me and the team. But I think the post-vaccine strength of the US economy and the financial markets attracts investors who are disenchanted with Europe and Japan's rising debt and slower growth. Treasuries maintain a positive yield, and I think that carry trade continues. Well, that concludes our 10 surprises for 2021. Every year, there are a number of also-rans. These are a few surprises that don't make the top 10 because either we don't think they're as relevant as those on the basic list, or we're not comfortable with the idea that they're quote unquote probable. So the first of the also-rans is cyber attacks, mostly from Eastern Europe and the Middle East. We think they will begin to have an economic impact. Bank account information is invaded and disfigured. Patient records are lost at hospitals, and credit collection companies can't keep track of customer purchases. Those tampering prove to be more skillful than those that are protecting the integrity of the data, and the dislocation cost becomes significant. The next surprise is Tesla. It acquires a major global auto manufacturer in a transaction that involves a combination of cash and stock. Elon Musk is named the CEO and pledges to eliminate the internal combustion engine by the end of the decade. And the last of the also-rans is Kim Jong-un threatens to explode his latest long-range missile capable, he says, of reaching Los Angeles. Trump invites him onto TV and convinces him not to do it. Trump then looks straight into the camera and says, people say I am the best negotiator.
Yeah, Joe, I just want to make a comment on the 11th surprise. We're now hearing that Russia has hacked a number of institutions in the United States. And we left Russia out of there, although it's implied perhaps. So one of the reasons a cyber surprise was not included is it's really in the news. It isn't any longer a surprise.
So that's the end of the also-rans for 2021. Now in the remainder of the time, we want to take you through some of the charts that helped to influence our thinking. So with that, we'll turn to the next slide. And this is looking at the pre-COVID versus post-COVID growth rates. And I think what's interesting about this pre-COVID growth rate, you can see on the left-hand side, OECD, the dotted line represents the pre-COVID growth rate for the global economy by the OECD. And now we have a combination of their base case, an upside, and a downside case. Obviously, global growth was massively impacted by COVID. But I think what's interesting here is if you look at the slide on the right, it looks at the pre-recession growth rate, an average of the last 3 recessions, 1991, 2000, and the Great Financial Crisis in 2008. So this is an average of the pre-recession growth rate. And then if you look at the solid line, that represents the actual growth. What it suggests is that there ends up being long-term permanent scarring that causes secular headwinds in each of the last 3 recoveries. And I think that's going to be the case as we recover in a post-COVID environment. 2021 is likely to be a bumper crop of growth and earnings. But as we settle out, I think what we're going to experience is a long but low growth cycle.
Joe, I think it's interesting on the left-hand side. Remember, we were saying it was going to be a square root shaped recovery, and we have a square root shaped recovery there in the downside case depicted on that panel. It doesn't look like it's going to turn out that way from the right-hand chart, but I think that's a pattern that looks like it's going to fit most closely to our experience.
I think that's right. And I think the second round of, or this newest round of stimulus is, again, more support for the economy that will turn into offense in 2021 and probably support a stronger than average growth rate. But that's a growth rate. And it's simply because we are comping off a very depressed growth in 2020. But as we settle out, I think what we need to be prepared for is something that is a longer and flatter recovery. So it may not exactly resemble the square root, but I think the point here is that in each of the last 3 recessions, actual growth ended up being a lot lower than the average of those forecasted growth rates. Turning to the next slide, this highlights what Byron and I put together in terms of a timeline. We did this in consultation with an external healthcare crisis management company, as well as internal business partners. And what I would point your attention to is the second and third quarter of 2021. And by sometime in the second or third quarter, I think most people will be able to get a vaccine. There's still some question as to herd immunity, what % of the population will, but the vaccine is one component of our COVID recovery. There are 2 other components that are important to remember, and that's access to low-cost rapid testing and better outpatient care. Those will cause hospitalization rates to stabilize, and with rapid low-cost testing, we can generally create the equivalent of COVID negative bubbles, areas where we can go and congregate with people who have been recently tested negative with COVID and thus reduce the risk of spread.
On this one, what we're showing here is where the roughly 900 billion of stimulus would provide support. I just want to emphasize the fact that while it is referred to as a stimulus package, it is really a relief package. We refer to it internally as a relief bill. And a lot of it is going to go to supplement income, small business, sector specific, to help airlines and public health. So the stimulus checks will go out. There'll be unemployment insurance benefits, rental assistance, because there's going to be a moratorium on rents, a supplemental nutritional aid program, and others. So we finally got the package. I don't know, I doubt that it's going to be the $2,000 checks that the Democrats and Trump seem to want, but at any rate, we do have a stimulus package that'll help the country during the difficult first quarter. On this one, you can just see what is happening here. We have an aging labor force. That's true in Europe and China as well. The only country with good demographics is India, but you can see that the labor force is declining and the share of the population over 65 is increasing. And this is one of the reasons we have to have a more liberal immigration policy to let people into this country who can do the jobs that need to be done.
And Byron, one point I would add here is we've often stressed in these webinars that growth over the long term really is just the combination of change in population plus change in productivity. And one of the reasons why we've seen a lower growth environment over the course of the last 20 or so years is that chart on the left, which is the labor force growth. It continues to slow. And it's no coincidence that the weakest recoveries or the weakest expansions were the last two. And it's because that population growth slows and productivity has actually been even a little bit below historic average as well. So this speaks to some of the long-term challenges that we see in this economy.
Yeah, as a mature economy, we're looking for 1% population growth and 1% productivity growth, and we haven't gotten either. Okay, well, this has been a strong recovery right out of the gates. As you see here from the green line, there's the global financial crisis, the recovery after 2008. It took 32 months to recover, and we went above where we were in 2019, 2 months after this started. So the early signs of this recovery are very optimistic, and that's one of the reasons we have a favorable outlook for both the economy and the market in 2021 after a correction in the first half. And the same is true of retail sales. They took 40 months to recover after the global financial crisis, but only 5 months to recover this time around. I just want to say a couple of things about it. One, while many of us, probably 40% of the population, can work from home and still be compensated for our white collar jobs, the bottom fifth of the workforce, 20% of the population that works in restaurants, hospitality, transportation, they can't do that. And so they're the ones that have been drawing on their savings and suffering the most. That's the group that we need to help with the current relief package. But we're optimistic that the economy is going to get back to where it was in 2019 faster than most people thought was possible. One of the reasons for that is the consumer is in very good shape. Their financial obligations are low, their debt service ratios are low, and their debt to income has improved. So the consumer is in a better position to start spending. And what's more, the average consumer has been quarantined, hasn't been spending any money, and there's plenty of pent-up demand out there, and we should see that unleashed into the system as people get vaccinated.
And what we want to stress is that these are all averages as we're looking at household balance sheets and consumer savings and the next few charts as well. But I really want to stress that it doesn't capture the hardship that so many people have experienced through loss of job and through COVID. These are really averages. And so in general, it's the consumer does look like he or she is in excellent shape, even though many people have struggled on an individual basis. And what this chart highlights here is the excess savings. There's still almost $1 trillion in excess savings, and relative to the pre-COVID rate, which as the economy generally begins to reopen and people start spending again on the services side of the economy, will help to drive growth in 2021. So as Byron said, what was initially deployed as defense in 2020 that put a floor under the economy will generally shift and give the consumer tremendous spending power. If you look at the next chart, while the savings rate is being drawn down, the Census Bureau, their household pulse survey shows that more respondents are using savings or selling assets to meet spending needs. Based on that savings rate that we showed in the last chart, we know that consumers can continue to do this for a while. However, it does suggest that if we don't get the economy going and COVID under control by the second half of next year, there could be additional problems in economic growth. The chart on the right-hand side illustrates a point that Byron made a minute ago, that many people haven't been spending. And what this looks at is the change in consumer spending by wage cohort. And it was middle income and high income people that actually had the greatest pullback in spending. And I think will end up being ultimately the source of that pent up demand. This chart highlights how we have had a quicker recovery in the labor market relative to the average of the last 5 recessions. But I also suspect a lot of the easy gains are now behind us. And if you look at the next chart, it will show that the US is about halfway back to its pre-COVID employment levels. But if you look at the other recessions that are plotted here, you can see that there ends up being a longer tail. So I think for that reason, the gains in the labor market are set to slow down.
Right. I just would make the point, employment is about halfway back to where it was in 2019, but incomes are about 3/4 of the way back because more generously compensated people have been able to work remotely.
So I won't spend a lot of time on this chart. I think we all know it well. Central bank policy rates and bonds have continued to make new lows in 2020. This chart looks at a combination of central bank policy rates for developed and emerging markets on the left, and then the global aggregate US, Eurozone, Japan, UK sovereign bond yields on the right. Next chart highlights that through the second quarter of 2020, debt levels increased by 70% since 2008, are at a record high of as a share of GDP. And credit to the global non-financial sector, as you can see on the right-hand side, as a percent of GDP is at an all-time high. So looking at negative yielding debt, it reached a record of $17.5 trillion globally. And the chart on the right-hand side shows global negative yielding corporate debt. There's now almost $1.5 trillion in negative yielding corporate debt. If we look at the next slide, it shows that corporate bond yields have reached all-time lows in the United States. At the same time, we've had record high issuance of high yield and investment grade debt. Now, corporate balance sheets are in some of the best conditions that we've ever seen. Corporations have more cash than they've ever had before on their balance sheets, and their cash as a percent of their assets is at levels that has not been seen since the 1960s. So record cash and lower than expected bankruptcies have pushed a lot of these spreads back to pre-COVID levels. But it's setting up what I think will be a conflict for investors in 2021. If we turn to the next chart, it shows that inflation expectations are actually starting to return. Inflation expectations now, when you look at the 10-year break-even rate, are back to pre-COVID levels, back to levels in mid-2019. And you can see on the right-hand side, fund flows to US listed ETFs investing in TIPS, inflation-protected securities, have been high. They've been positive. So investors are betting or believing that inflation is set to return, yet we've seen an all-time record issuance in high-yield investment-grade debt and lower spreads and negative yielding corporate bonds. The two of those should not coexist. Negative yielding debt and higher inflation expectations. It's going to set up a conflict for investors in 2021, in my view.
Okay, let's take a look at the market here. One of the things that we said in the 10 surprises is that we're going to have a major correction in the first half, and this is the reason why. Sentiment is right up there near the top of the range of where it gets. People think they're immune from market corrections. Nothing could go wrong. The economy is doing well, and we have a vaccine coming. And so that's a very dangerous, complacent attitude. That's why we think the market is vulnerable to a correction. If you look at where we are in terms of attitudes toward equities, households are positive in the 96th percentile, foreign investors the 93rd, mutual funds 86, pension funds 77, total 97. So, you know, everybody is too optimistic, and that creates a dangerous environment for equities. And that's why we're a little apprehensive at the present time. We still think the year is going to be good, and the S&P 500 could get to 4,500, but we do think there's danger in the first half. This one shows the dividend discount model and what the market is pricing in. The 10-year Treasury is near 1%, and based on earnings estimates that will be rising over the next year to the 180 level, the market is still at its current level of about 3,700, still ahead of itself. In order to really be fairly priced, the 10-year Treasury would have to decline at least to 0.5%, or even 0.25%. Now, when the market opens each day, it doesn't know I have this page in my handout, so it doesn't always trade right on the number. But this valuation model is complementary to the crowd sentiment poll. What it says is the market is ahead of itself and is in dangerous territory.
You know, as Byron's saying, this is a market that is not cheap. You know, I think we will end up seeing new records being set on virtually every valuation metric out there. I think we'll end up setting records on price to earnings, EV to EBITDA, price to sales, et cetera. I think we'll end up breaking all the records that were set in 1999 during the tech bubble before this market runs its course. It won't be without volatility, of course. As you know, Byron said earlier in the surprises, you know, risk on isn't without risk. So we think there will be volatility, but the combination of accommodative Fed policy and excess liquidity, I think will continue to push markets higher and higher. At 28.5, almost 28.5 times earnings, historically, you get a 10-year annualized return that is negative. And you see that on the scatter plot on the left-hand side. And looking at the S&P 500 valuation on a forward valuation on a decile basis, you can see at its highest decile, where we are today, you get your lowest 10-year CAGR. I think that sets up what will be a more challenging long-term bull market, where we might get the short-term outperformance because of the recovery year in 2021. But I think it sets the stage that longer term, this cycle, we should expect below average returns. This chart looks at volatility between treasuries and equities. And 2020 was a remarkable year in that we saw a much different type of volatility in treasuries than we had seen in equities. While equity vol went higher, Fed policy plus QE kept treasury volatility very much intact. As the Fed winds down the expansion of its balance sheet, in other words, I don't think it'll be expanding its balance sheet at anywhere near the pace we saw in 2020. I would expect that the relationship between treasury and equity vol will begin to normalize. We could end up seeing more volatility in treasury markets. That's going to create a conundrum for the Fed, who's going to want to try to keep rates anchored. And I think it will end up having to engage in alternative, additional forms of QE and some version of an Operation Twist 2.0 in order to try to keep rates low and try to battle back against some of that Treasury volatility. Next chart looks at small caps. I think they'll outperform as we see the unwind of that K trade. I think cyclicals, deep cyclicals, small cap, low quality will end up being the winners in 2021. This chart looks at EBITDA growth in 2021 versus 2019 levels for small and large cap. And you can see that because of the low base, the base effect, small caps are going to end up having a bigger earnings growth rate, and that relative performance between small and large, I think will continue to reverse itself. As you can see, it started to reverse itself at the end of 2020. I think that trend continues as that K-shaped recovery in the markets unwinds. This next chart is a concept that I am borrowing from investor and philanthropist Lee Cooperman, who described bonds as being return-free risk. And what this chart highlights is real yields adjusted for inflation on corporate bonds turned negative. In other words, investors are not getting paid for interest rate risk, duration risk, or credit risk. That makes traditional bonds very risky in my view. So with that, I want to thank Byron and thank everyone for tuning in to our 10 surprises for 2021. As always, look out for our essays and market insights, and we welcome your thoughts. Thank you.